aspects, I do want to check one thing because I want to do a poll. And I'm just going to make sure that I can do that. 1 second. And then we'll get going. Let me see. Sorry for the delay here. Well, maybe I think what I'm going to do is while you talk, Stephen, I'll finalize this. So I'll go back to the main screen. Sorry about that. All right. So we just talked about the cadence, and I'll just borrow a slide for everybody of what we're doing because I was just explaining to the co-leaders that we're going to have I look at it really from Thursday. Thursday, where the co-leaders are going to get together and, to the extent that they can also give us, they're going to throw things on the app or otherwise get together to collaborate in the kind of events that they want to put together. And we're going to support them, and then we're going to put it out in the form of a digest. Hopefully many of you receive this digest by mail. We're going to do them. We're going to get them out on Mondays. And then from there, Fridays we'll announce the agenda. It's usually Stephen Burke that I have to, what are we going to talk about this time, Stephen? So we try to figure that out, and then and see what's going to go in that digest. And then Monday put it out, and then Tuesdays at 10:30 the groups come together, and then we have this weekly briefing. And when I was just going over as to how to help them, do what the future of work is, create their own events, and just leverage the platform so we get more great events like we had last Tuesday. And again, this is sort of the world that as we see it with all the different kind of groups, and those groups can obviously interconnect as we bring in the alumni. You might have a Michigan alum doing something with sports and media, which actually this is all a true thing that's happening right now with a McKinsey person. And some other events that I'm going to focus on is the good, bad, ugly of direct investing. We thought today we would revisit a topic. I was telling Joe Zaro, we've done about 100 plus one-on-ones, and so many families are going to gold and cash and safety, and others are doubling down. So you get the whole spectrum. We thought it would be an interesting way to get people together and talk about what's happening. I know that Stephen Burke, you're going to see his slides. He's actually not supposedly going to do pessimism and optimism. He's going to talk about cryptocurrency and how the big pension funds that are publishing their results, their challenges and their performance to set the stage for this discussion on asset allocation. So with that, I'm going to say when he finishes, we're going to go into random breakouts. We'll size them so we have at least 5, 6, 7 people, and then have everybody sort of discuss how they see the world, and then come back. And we'll try to give everybody at least 10 minutes, and then come back and we'll share what we're hearing, what we're thinking. Trying to look for everyone's going to be different. And I'll go over this one more time, but you all have different risk tolerances, objectives, starting points, generations. So none of one's the same, but at least you see things that are happening. Those are the things we want to pull out. What are the trends that people are seeing, and so that people could learn from each other. So with that, although I have your slides, Stephen, I think you always like to take control. So I will stop sharing if you're ready. Are you ready?
Thank you.
All right.
Okay, am I up on your screen, Mark?
Yep.
Okay, great. So interesting time to be investors, and the question that I thought would be worth raising is it time to adjust your investing playbook? And I thought about a quote from Ben Graham that really spoke to me as the great value investor. One of the things that I don't think he gets enough credit for is his ability to adapt to the circumstances and take advantage of opportunities or adjust your process. So I thought this quote from him was quite applicable about the environment we're in. as the current economic, social, and political backdrop is without precedent, it's time to rethink a lot of things that we talked about. So today I want to cover two topics. Talk about CBDC, which is not cannabis, but central bank digital currencies, and talk about it from the central banker's perspective, and then talk about asset allocation and returns and what some of the public pension fund sovereigns and one of the leading investors is saying. So back in 2018, the head of the BIS, the Bank of International Settlements, which is the central banker's banker, put out a report he gave a speech. In his speech, he highlighted 10 flaws of the concerns that the BIS has about cryptocurrencies. And I got to thinking after our last week's call when Jonah and I think it was Anthony from London were talking about their enthusiasm for Bitcoin, I thought, where's the disconnect? And I wanted to just touch on this quickly. These are the key issues that they raised, but I think it really is about how do you have an economy that you can regulate when it overheats and is going too slow, or you're facing deflation. That was usually the role of the central banks, to either raise rates or lower rates to stimulate or slow down the economy. But key to that is also the control of your currency, and that was actually one of the big issues. So I don't want to go into each of these items, but when they talk about economic design flaws, it was actually one of the more interesting parts of the research is that they were focusing on the data volume and what that means when you take a global economy, take all the transactions, and if you ever move them all to a cryptocurrency arrangement, you have some problems that every transaction adds a few hundred bytes to the blockchain, and the file sizes to handle national payment systems would add tens of thousands of gigabytes in just a few weeks. So there are natural constraints to the mining and the process of blockchain. And I am not an expert, but I am sharing what the concerns of the central bankers are. And they're concerned about the ability to manage the size of the blockchain, and then also how many transactions can be processed at the same speed and accuracy and safety that you're seeing with the other payment processors like a MasterCard, a Visa, or others. They're also concerned about the finality of the payment and constraints on the system, but also the fact that cryptocurrencies have proven to be not very stable in terms of pricing, as we've seen from the rise and fall again, or now back up to pretty heady levels. That makes it hard to make it a store of value and to use as a means of payment and a unit of account. So that's one of the other concerns that the central bankers have, because you have to have confidence that the supply is going to be predetermined by some protocols. And that gets into the supply elasticity and the debasement if you don't have those protocols in place on a fully blockchain or cryptocurrency environment. Would you run the risk of supply and demand being out of whack? There's no central agent to deal with the obligations or incentives to stabilize value. As demand decreases, so does the price. So that's not a great environment for running a global economy or for running a country's economy. And the other issue that they raised was that retail purchases are a bit of a challenge, in that back in 2017, it could cost anywhere from $16 to $17 to process a transaction. So depending on the cost of what you're purchasing for retail, is that a practical application or not? When you think about it, the highest daily volume back in 2017 was about $400 million on blockchain and Bitcoin transactions. Visa alone processes 500 million transactions each month. Is it going to work for merchants and all that? Those are all the things that go through the mind of central bankers when they're looking at this. So where are central bankers now? Because the talk is heating up and central bankers are looking at this in earnest now. But in a survey done by the BIS last year, they found that only 25% of banks had the authority. Most didn't, and most didn't think they were going to be doing anything in crypto in the foreseeable future. And we know in our world that what your plans are and how things work out actually don't coincide. And I think the pandemic is accelerating the way they're looking at it, but it's not on the forefront of central bankers' minds. although there is a lot of research being done on that. The Federal Reserve announced last week that they've been in a multi-year program with other central banks and with MIT to look at the impacts on the system and hear their concerns. And a lot of it is, I think there's too much goes to the illicit activity. I think what they're really focused on is financial stability and currency stability and cross-border transactions. Think about a world where right now the dollar is reserve currency. Most commodities trade off of the dollar. And when they're not trading off the dollar, a lot of central banks set up swap lines to deal with the dollar shortages or not. That becomes much more difficult to do in an environment in a crypto or blockchain environment. So those are some of the issues that they're focused on. And it's just a different perspective of what they're worried about is financial stability. Because if you go back to what's the role of a central bank, it's usually one of two things are the primary issues: price stability and employment, depending on the central bank. And price stability is one of their big concerns here. That's not even to get into the cyber issues that they're worried that are going to come along with that. So switching gears, I wanted to just touch on asset allocation and returns. And Equitable Institute came out with a study last week. They looked at the 143 largest public pensions in the US, and their average return for the last 12 months was minus 0.4% versus a target of 7.2. So the funding gap is growing. It's now 1.6 trillion. The aggregate funding ratio is dropping, and it's on its way to the pre-crisis, the 2008 lows, which was around 63% funding ratio. And then when you get into a state level, and we're going into a period where the state finances are a mess because of the pandemic, you look at California, Illinois, New Jersey, Texas, and Pennsylvania, their shortfall is more than the rest of the country's shortfall combined. Now, that's a pretty startling number for those 5 states. What happens when you start raising taxes? Do you lose people from the state? You're having state employers are going to have to lay off people to deal with their revenue shortfalls. So that's another factor. So you end up with fewer people working, paying into the system, more people retired. The math doesn't work. And that's actually one of the big issues. And that gets to how do you deal with that from an asset allocation perspective. So you have bad math here, and it's the same in Canada. I think OMS had a statistic out where they looked at from 1990 to 2016, the average of their 333,000 members, their average time worked in the system dropped from 29 years to 25. Time receiving payouts went from 26 years to 32 years. Think of the math of that and how that's going to impact what they need to generate for returns in what is a tough return environment. And it's not alone. The sovereign wealth funds are seeing the same thing. Norges, which is the largest sovereign wealth fund, just announced their returns for the fiscal year ending June 30th, minus 3.4%. They've averaged about 5.8% going back for, just shy of 20 years. But when you look at, 22 years, when you look at where they're allocated right now, they can be up to 70% in equities, up to 30% in bonds, and up to 7% in unlisted real estate. That's not an allocation that we would be too far away from. Whether you would lower the bond ratings, the allocation, look at alternatives differently, or just increase your equity, that feels like not an uncomfortable level. And then when you look at what Jeff Gundlach came out with the other day, who is the bond king now, is talking about his net duration on bonds is 0. He believes the economy is, like us, more deflation prone. So he's focused on cash to guard against deflation, gold for long-term value, and stocks because they'll do well if there is inflation. So you see people all over the board for each family because each family's needs are different. But I would say rethink the allocation strategies and where you're putting your money in this environment, because the world is so different than it was just 6 months ago. And we had problems then because we're at a rate environment that's unprecedented. You have a narrowness of the stock markets that is unprecedented. Money coming in from liquidity from central banks and fiscal stimulus carrying the system. So it's not a normal environment, and in a non-normal environment, it's time to rethink where you're allocating your money to and where the opportunities are. So with that, Mark, I'll stop, take any questions, and I just wanted to share a different perspective on the crypto as to why central banks are not engaging the way other people are.
That's great.
Yeah, Stephen, a great summary here and some really big questions. I'll leave the Bitcoin thing alone because we could spend all day on that one. But I think on the asset allocation side, certainly with the latest actions, from March, the Federal Reserve, essentially driving interest rates down into zero. I mean, people have been looking for yield, forever. But now, just doing the math, and especially if you incorporate, stuff like, Rob Arnott's expectations on equity or GLS, for us, we're really looking at a huge deficit at the 60/40 model, and really kind of traditional portfolio asset allocation techniques just doesn't move the needle anymore. So, I'll make a statement and ask it as a question. It seems as though that this is a great time, for really skill-based active management, certainly on the equity side. On the fixed income side, it looks like going to true alternative types of strategies, relative value, arbitrage type stuff, in order to replace that yield is a direction that people might be going. Any thoughts on that?
I think you're right on that, Bill. I would just say one thing that's a little different, a little controversial, but I think you have to separate the equity market into two as well, and think about the dividend payers in equities that are low growth but high quality companies that are maybe a better alternative to fixed income than some of the other riskier fixed income options that you can get, at a very comfortable level. You can get between, 2.5% and 5% dividend and 4% dividend income without really stretching in terms of quality, and still get a better blended rate of return. I think you need the growth, and I'm not sure a lot of the fixed income can get it from the current levels. We had a great opportunity with high yield, but I think the other things are tightening up. And I think you might want to bifurcate the equity market into dividend payers that have reasonable growth versus the dividend payers that are deep in the value category that you have to worry about, are they going to stay there or not, versus the high-flying growth companies that you want to have where active management can really play. And then you do need to take shots at select areas of the fixed income market, but I have a hard time being long in any of those areas. That's the one problem I have from a fixed income side right now. Private debt is also another alternative, but I think even in the private equity area and other areas, we have to go with the assumption that the returns that we are working off of might not be even close to what we're going to get. And you've seen that with private equity allocations or estimates coming down for a lot of the big public pension plans. They're thinking it's 3% excess, going down to 1.5% excess returns over public. So I think it's just going to be tougher all around. And I think you're going to have to see states contributing more to their pension plans. And if you're not in that area, you're just going to have to deal with lower return expectations, I think.
Hey, Stephen, it's Rob Cullerin here. Toward the end, the commentary on the Norwegian sovereign fund.
Yes.
Correct me if I'm wrong, but they seemed a little bit aggressive, or let's say overly transparent. Was that a sort of a strategy to share the bad news for whatever this $35 billion loss valuation and work from there? Do you see that some other comparable entities? Or is that something that you're seeing?
I think they're the most transparent of the subs in general. It's very much a part, and someone speak to this maybe better than I can, but it seems to be very much a part of their transparency is a big issue with them, and they're so much the country relies on the sovereign wealth fund that they tend to be very open about it. A other countries are much less open about what they're doing and how they've performed. But in general, it's good to get the bad news out of the way. There's, you know, when you're delivering they have other issues right now as to the question of their new CIO or head of their fund, whether he's going to divest his holding in his hedge fund that he's an owner of now.
Well, but again, it is more of a, you know, that's the current status of things, and I think building a case of how that kind of comes back. So hopefully it's not a permanent loss.
Well, no, and you look at these guys, I mean, they own really basically 1.5% of every listed equity in the world. So, you know, except the area that they cut back on is the only two fossil fuel companies own, I believe, are Royal Dutch Shell and BP. They've divested all the other ones now. So that's another thing that's going to play into this is actually how we think of climate change in portfolios and ESG in portfolios, and what's that do to the way companies actually are considered for inclusion in portfolios as well. So a lot of issues facing asset allocators right now, as you guys live with every day. But I think the only way you're going to get there comfortably is in equities. Now we have another wrinkle for things. You know, the COVID has changed the way we think about real estate, or maybe changing the way people think of real estate return, and that another wrinkle into asset allocation strategies that is worth a much longer discussion with people more knowledgeable about real estate than I.
Stephen?
Yes.
Snapshot of what's going and I wonder, I happen to believe that the coronavirus has simply accelerated the structural problems that the world is facing. You know, I'm a big believer in the bond market tells the truth. And so, and I happen to think that the stock market today is a little bit of self-fulfilling type of investment, where the bond, being honest, it's pretty tough spot to put their money into equities, because that's the industry you're going to put your money today. And so not just looking at, you know, if we get a vaccine tomorrow, it's not the cure all, right? And everyone will feel very good about it, but I think this has just, you know, really accelerated some real structural problems that the world is facing, the United States is facing. What kind of, as you kind of fast forward, or what does your movie play out to look like over the next, you know, 2, 3, 5 years? I think it's coronavirus independent. At some point we'll get past this. There'll be a vaccine. But you know, had there been, if you will, damage done that has moved us forward into some day of reckoning that has to come very soon, and what that is, what that looks like? Well,
you know, it's you're 100% right. It has, there are distortions. I look at the equity market differently than you do. I think the bond market is telling you what the bond market's telling you, that we're in a very difficult growth period globally, and almost every country is reflecting that. But the equity market, I think we're making a message when it's multiple messages. I think you have a return to the market that's driven by a small number of companies, and the companies are telling the same message that the bond market's telling you. So I think we do have structural problems, and they're going to be with us for some time. We deal with longer term, and I saw an article this week comparing China today to Japan in the 80s, and I think Japan in the 80s is going to be a broader message than just China. I think it's going to be a message about when you get into a period where you're having trouble getting growth, and you have all the other issues you have to deal with, and you're highly indebted, you're going to stay that way for a long time. And Gunlock's of the view that
it did come through. So you can see the distribution of people, or a lot of U.S. on the Atlantic coast. single families, different types. We're investing, most are investing in public, some debt, a lot of VCPE, not as much credit, gold. Which class is going to win? Mostly think VCPE. That's a debate to be had, right, Stephen? And then to the extent which one, how you react. So we'll share these results. But let me click a button so that we go out and meet some people, and let's talk about this and come back in 10 minutes. 1 second, here we go. I'll create 6 rooms. All right, see you soon.
Hey, Mark, I was in a breakout room with Bill Curtis, Andrew Randak, and out. I don't know if you can put me back in.
Just when things were getting good, Mark.
Yeah. That's what she said. Okay. So let's go around the rooms. Speak, Andrew, tell us how good it was.
Sorry.
Actually, people are still joining.
There you go.
I'll let people join here a few more.
Hey, Stephen Burke, after the election. That's my
After the
answer.
election?
Yeah,
Okay.
it's just before
So
my after the election. I mean, fully normalized, maybe a little longer than
Ken,
that.
hold your thoughts. Unless you guys want to go first. I was going to let Andrew go, but if you and Andrew, why don't you kick off? What did your group think?
We actually jumped around in a lot of different topics. Media, Bill Curtis, we were talking about his podcasts, and I brought up a newsletter that my brother sent me in tech space, written by a guy named Matthew Goldstein, who does a big recap of the tectonic shifts going on in media. I would recommend people look for that. I can try to find a link and send it to people, but it's fascinating. Talked about the future of work. Paul's microphone didn't work, and then then just as things were taking off, we got yanked back into reality. So like a good dream.
Yeah, fair enough. Which group wants to go next? Stephen and Ken, or who's your spokespeople?
We never pick one. We're still making
Stephen.
introductions, and then went back into the group. No, we're actually talking about the where we see the opportunities, and there was a view that that there's still opportunities in each of the areas, whether it's venture or private equity or the public markets. The question then got into how can the FANGs or the FANGs Plus or the Five Horsemen or whatever you want to call them keep going up, particularly with Apple. And that's a question we didn't get to resolution on, but certainly one. And then the other issue that came up is discuss that in earnest about if it goes one way, what's the outcome? If it goes another way, what's the outcome? So that's probably, Mark, worth a whole session on, two sides of the coin there.
Thank you,
And then
Stephen.
Ken's just saying that he thinks we're going to get back to normal when, Ken?
I think there's going to be when this whole thing is less politicized. I think a lot of people are getting their information from television, and the experiential world is less involved than it should be. But and obviously a vaccine will help all that, but I think you'll see a lot more normalcy as things progress. That's just my opinion.
Fair enough.
I mean, I on the call, on our group just pointed out that China is in my space, just did an $80 million box office on a Chinese film. So that's interesting to see what's happening in other countries, right? And certainly in my space, people.
That's just the China market.
Yeah. And we're seeing like our, with my company, Kevin just went back to shooting Yellowstone.
Next group, that'd be Joe.
I'm still here, Mark. I'm still here. Were you asking me a question?
Well, let's keep it going around the house. I was, but we'll keep it going. I think I had a bad internet connection, or you did. Joe, you want to share what your group talked about? Or
Yeah, sure. So Rob Collarino, myself, Sean Lawless, Dave Kroom, and Robert Winspear were kind of chatting about real estate. And I think Dave Kroom was kind of specifically asking about how this is all impacting gyms, and if there's going to be some kind of stimulus for helping landlords specifically and owners of businesses, the small businesses where maybe that people aren't feeling comfortable to kind of get back in and working out. And some interesting points about how people are working out nowadays and not working out or trying to get back to gym or motivation. And so, yeah, we mostly spoke about that.
Hey, Joe, just one footnote on that. That was, I think, interesting that, the question you deal with you have, or you take I think David had an interesting thing from Seattle about do you roll some of the weaker entities. That was an interesting, go or no go type of dynamic. And I think there's mechanisms depending on the distress of those target entities, which can play out to the new investor.
Yes, sir.
So, that's that applies to a lot of different
Yes,
industries.
sir.
So how about, was the next group? Torin, you and Jeff were talking a little bit with Vadim.
Yeah, so we were talking a lot about the evolving regulatory environment for the FDA and the Korean FDA equivalent, and how the timeframes for things to get through clinical trials are evolving, and the potentially long-term effects of the stalled, delayed, or stopped clinical drug trials that were going on in the United States. I mean, we may be feeling that this may slow drug development for years to come for things outside of COVID. I mean, so many of these trials had to be stopped or heavily delayed.
Got it. And who else? Chris Mayo, you want another group, or trying to remember the next?
Mark, I'll go ahead. We got through introductions, and a couple of interesting things came up. Bob Blake, who is in television, was relating the difficult economics there, where the viewership is up, but advertising dollars are not as available. And then MJ, we spent a lot of time at my instigation with MJ and learning about his business model, which is a social app for both a social treatment app, an ecosystem for people who are recovering from addictions, and found that very interesting as approach and the commitment to the mission of his, I think it's Lucid app, and it was a very good discussion. Didn't get much beyond that with the.
Where do we invest our money? In Lucid or?
No, if we have gotten, we didn't transition to the topic.
Might as well.
Of course. Talking his book. That's okay. How about what other group? We have one or two others.
Thanks, Mark.
Who else?
Well, we spoke in our group about the healthcare space. And the conversation was, what happens to utilization in healthcare? Specifically, have people become accustomed to has behavior changed in the amount you go to see your doctor, and will people still elect to see their doctors as frequently, or they rely on telehealth, and how that change the entire behavior. Then we talked a little bit about the economy itself, and when COVID-19 started, everybody thought it would last. How much has psychology now been changed, and how people think and have modified their behavior, and what's that long-term impact look like? And then lastly, we talked a little bit about venture capital and attractive places to invest, and why that's why the comment was made. Apple and Tesla stocks should not be priced as high as they are right now, and so and Jonah did bring up that what they're seeing is some small cap video game companies are seeing life, a little bit of a Lazarus moment. They were long thought to be on their way out, and because there's just so much demand right now for video games and for new different video games.
Yeah, I can definitely touch on that, and I appreciate you bringing that up. Of course, everything I
Well, just before you do, Jonah, because you talked about the mental health, sort of the mentality, the psychology, right? How, and it reminds me, if everybody could, if you didn't see the work, and now it's a marathon. It's like a sprint marathon. It really is challenging. You may want to check out that one, and then this the third one. Yeah, Jonah, you're probably the best place to talk about it. But one more. As Public Markets is going to team up with tech, and not talk about venture tech, but FANG stocks. And we're going to try to bring Heather Bellini. She's the Denison. She's the Goldman's analyst, lead analyst. She covers Apple. She covers FANG.
Mm-hmm.
So go ahead, Jonah.
Yeah, absolutely. So, and thank you, Joe. I think it was a great conversation. I'll say on telehealth, I think there's a big business in the hardware side of that, having actual medical equipment in your house. But I'm not an expert in that, so I won't speak to it. What's interesting to me, and I say video games because it correlates, video games are no longer just video games, it's all entertainment. So like it runs the market of entertainment. It's bigger than movies, it's bigger than music, it's bigger than all that by a long shot. And so when you look at it, what I found is there's not only just good VC plays, but there's good public plays, especially in like smaller cap public companies that are not your Activisions of the world, but maybe your next Activision in the future. Your next Google or Activision because of this sort of terrible COVID experience, and they're finding new ways to change the world. And we're very interested in that here, which is why we are starting, and we're in the process of the new Game Fund, which is a $300 million fund with an amazing team that's focused on investing in those opportunities.
Yeah.
Well, you never shared that with us, Jonah. So did you know that we raised money for
Well, it's a new.
I'm joking. So let's. Who else wants to speak before we sign off? Just whatever groups. You've heard these themes. You've got some insights.
Mark, I would just add the point Jonah just made about innovation for our country and for many countries is actually the bright light that gets lost in what's going on with the pandemic and with the politics and all that. And you really look back over the last 100 years or 200 years, and you can see every time we're at a big innovation point, things really change and the whole mindset changes. And they usually come out of periods of real difficulties. So I think we should keep an eye on that. Keep that in our mind when we're thinking about all the negativity that's out there. Our ability to innovate and change the way we live is beyond what we can even imagine now. And I think that's a point that we lose track of.
This is where I wanted to put you with some of the families that Joe and I have been interviewing that are rushing to gold and cash, because people like you are still, positive on the public equities. Interest rates are low, but innovation is part of your thesis, and have a counterpoint.
I was curious, Mark, if any of the people talking about health have talked about the role that Amazon, Apple, and Google might play in the healthcare going forward. As part of the healthcare system and lowering costs and improving the pre-sickness health issues and all that, because they're spending a lot of money on picking up technologies that are going to help in that area for them to be bigger players. And in the U.S., they could cut 1.7 trillion of costs.
To your point, and another reason why I don't invest directly into venture that often is one of the guys, really smart guy, Judd Truppigan, Plowpenny Family Office, said, his screen is, can Google, Apple overtake you? And, you think of everybody with the Fitbits and everything, Apple just takes it, and Google. So to your point, they keep on they keep on getting bigger and bigger and separating.
For them, a $400 million acquisition of key technologies is nothing. And for everyone else, it's a big deal. So if they keep bringing those technologies in, knows whether they can take it. So, You know, it's not too long ago that people thought, you know, you couldn't sell many more iPhones. And then Apple created a whole new $50 billion market with the services business. So, you know, what's healthcare potentially for them is a way to look at it. So just as food for thought.
Yep. Any other thoughts? All right, well, it's 30 seconds to 12. If I give the floor to Duncan, he'll make it a 5-minute comment, so I can't do that. Anyone? So again, just for us, we're gonna do, just so you know, 10:30 is when we're on Tuesdays and Thursdays, and the Thursdays are gonna help us, give us the information, insights and posts, but please use the app as much as you can. So the activity is there. And then we're going to do like a roundup digest that went out today. You'll see that going to all the app registrants, for lack of a better word. And then we'll do more deep dives. And we're looking at Tuesdays and Thursdays at 11:30 is a good timing to keep as we go forward. But, you know, one coming up on blockchain, you know, then that's where you can pontificate, Duncan, if you have your various theories. Just pick a topic and we give you and we'll put a panel around you. You can moderate it like Simon Vine. Or Torrin, if you want to talk about some of your technologies and portfolio companies, you know, bring them on. That's the whole
Mark,
point.
hey, Mark, if you all saw any of the RNC last night, it seems like the Republican Party isn't dead yet. I think I wouldn't discount Trump.
What? You're violating one of those rules I had up there in that important notice.
Yeah,
I'm not going to go. We're not going there.
I'm being apolitical.
Okay.
I'm just being scientific, but politics is part of business.